Welcome everyone to this webinar. This is hosted by ATAF and IGF. So ATAF is the African Tax Administration Forum, and IGF is the Intergovernmental Forum on Mining. So we collaborate with ATAF on many topics, but in particular this one, which is very important to our member countries. So as you know, there is a global reform on taxation that has been proposed at the global level to change a number of global tax rules. Many of your countries are involved in the negotiation, and probably all of your countries will be impacted by the outcome. The outcome has there's been an additional momentum given to the reform since recently the US administration has taken all positions on the reform and given it a new impetus. So things are moving really fast, and we thought it was important to highlight a few of the potential challenges that are currently in the blueprints of the reform. So we published an initial briefing note that summarized the main impacts on the mining sector from the reform in January. And last month, we published a longer report where we look in more detail at one particular issue, that of timing difference that arise under the second pillar of the reform. So we're going to talk about this today in detail. The agenda for today is going to follow the report that we published, but we'll try to really make it accessible, explain the problem, what the problem is, and how it could impact the mining sector in your countries. So we're going to have three speakers today. So first, you're going to hear from Lee Corrick, who's a senior technical advisor at IATAF. Then Alexandra Whitehead, who works with me at IGF, and she's the lead of the tax and extractives program. And myself, Thomas Lasso, senior policy advisor within the tax and extractives program at the IGF. And we start with the first part of the agenda with Lee Corrick. Then it will be myself, and Ali then will talk about the potential solutions to problems we discuss. Thank you very much, and Lee, up to you. Let me know when I need to change the slides.
Thanks very much, Thomas, and welcome to everyone. So in this first part of the presentation, I'll give you a bit of an overview of what's happening in terms of what gets called Pillar 2 of the Inclusive Framework's work on the taxation of the digitalization of the economy. Bearing in mind that actually Pillar 2 has nothing to do with digital taxation, and is primarily about addressing so-called remaining BEPS issues. So could I ask you to go to the next slide, please, Thomas? So what is the policy objective of Pillar 2? Well, broadly, it's to make sure that all of a multinational company's global profits are taxed at least at a minimum effective rate. So when we say at least at a minimum effective rate, there will of course be jurisdictions where the tax rate is well above the minimum effective rate, and therefore those profits will remain taxed as they are under the current system. A lot of debate about what the minimum effective tax rate should be. Most of the discussions have taken place on the basis that it's likely to be somewhere between 10 and 15%. But as Thomas mentioned earlier, part of the US's recent proposals is to change their own global minimum effective tax rate under what's called the GILTI rules from 10.5% to 21%, in line with also increasing their statutory CIT rate, corporate income tax rate, from 21% to 28%. Now those are proposals put forward by the Biden administration, still obviously to go through Congress. So whether they get agreed or not, we will have to wait and see. That has moved some of the discussion about what the globe minimum effective tax rate should be, and whether maybe it should be closer to the proposal from the US. From an African perspective, the African Union has stated it thinks the rate should be at least 20%, so perhaps more aligned with the US proposal. Also worth bearing in mind when we talk about multinational companies here, it will not be all multinational companies. It's likely it will be only those multinationals with global revenue of more than 750 million euros per annum, although again, that's still to be agreed. And the mechanics of this rule will be that what happens is there's a calculation of what is the minimum effective tax rate of entities of the multinational on a country-by-country basis. So you may hear this referred to as jurisdictional blending. So in other words, all of the income profits is what we mean by that, of all the entities of the group in a particular jurisdiction are all blended together, as is the amount of tax they pay in that jurisdiction. So it's done jurisdiction by jurisdiction. That also differs from the current US GILTI rules, where they have a global blending rather than a jurisdictional blending approach. But the new US proposal is to move to a jurisdictional blending. I think there's an acknowledgement in the US that global blending provides plenty of tax planning opportunities and makes the GILTI rule fairly ineffective. So that's the way the rule is calculated. Now, when you're looking, obviously, you're looking at the income here and you're looking at the tax that's paid. Now, one of the issues that raises is how do we deal with what we call timing differences or temporary differences? So, for example, you may see tax depreciation, which is under the local tax rule, which differs from the accounting depreciation. And you'll see in the slide here, we talk about the fact, this is very important in the mining sector. So it's a large capital expenditure sector. Much of that capital expenditure is up front, well before the income streams start flowing. And in some countries, you will get some form of accelerated tax depreciation allowance, which will not be aligned to the accounting depreciation. And some of the slides later will talk about that in quite a bit more detail. So these timing differences, they're recognized in what's called the Pillar 2 Blueprint report, which was released in October 2020. You can access that report online. It's very long, it's about 250 pages long, and it does talk about the issue of timing differences. But that report makes clear that at the moment there's no real agreement on the timing difference issue, as there is no agreement on many of the issues in that blueprint. And so more work still being done on that, but as ATAF and IGF, we've identified that this is a key issue for resource-rich countries, very important in the mining sector. So hence the reason for this publication and bringing to your attention that this is an issue that's live at the moment, still under discussion at the inclusive framework. And bear in mind, the inclusive framework has a deadline set for it by the G20 of trying to reach a global agreement on Pillar 1 and Pillar 2 by mid-2021. In practice, that means by the end of June 2021, in time for the next G20 finance ministers meeting, which is in early July 2021. So that deadline is speeding towards us. So this is an important issue to keep an eye on and make sure the outcome is the right and most appropriate outcome for resource-rich countries. So Thomas, can I ask you to go to the next slide, please? So, as I said, calculated at a jurisdictional level. So this is what some people could call a global level. And what it looks at is what it says here, subsidiaries effective tax rate. If there's more than one subsidiary in the country, you will blend those subsidiaries results together and look at the effective tax rate for all of the subsidiaries. And if that effective tax rate is below the minimum globally agreed rate, which, as I say, is still under discussion, then there will be a top-up tax paid. And that top-up tax is the difference between the effective tax rate and the minimum globally agreed rate. So it does not top it up to another jurisdiction's tax rate. it tops it up to the minimum effective rate. And you'll see in the slide, it says it's the top-up tax will be paid to the country where its parent company is located. So this is under what's called the income inclusion rule. For those of you who know about international tax rules, the income inclusion rule is fairly similar to a controlled foreign companies rule, which are largely used in large developed countries who have a lot of parent entities in the country. So this again was a residence-based rule, so it gives residents taxation rights to the jurisdiction where the parent company is. So if you have a mining company in your country and it has an effective tax rate which is below the globally agreed rate, then the top-up tax will go to the parent of the mining subsidiary. And as you can see in the next slide, the next bullet, a couple of things I've already mentioned. Been talk about 10 to 15% for the minimum global rate. A lot of countries think that'll be around 12.5%, probably because that's the Irish CIT rate. And as you can see, the African Union, we flagged up, we think it should be at least 20%, and IGF pretty much aligned with us. Think that maybe even that's too low for the mining sector. And as I mentioned, US, for its own domestic rules, recently proposed 21%. So we go to the next slide, please, Thomas. So how do we calculate the effective tax rate? Again, this is explained in quite a lot of detail in the Pillar 2 proposal, and obviously in more detail in our joint publication. So the global effective tax rate will equal the covered taxes, and explains here what the covered taxes are. So this is the cash tax paid. So slight difference from what you see often used. Here we're not looking at tax payable, we're looking at the actual tax paid. And this type of information will be available to tax administrations through the country-by-country report, which uses a tax paid figure as well. So you look at the tax paid in the current year, and then it's divided by what's called the global tax base. So this is the profit or loss before income, using essentially the financial accounting standards. In most cases, most countries' financial accounting standards will be accepted for the purpose of the globe rule. There may be a few exceptions, but most are likely to be accepted. So the starting point for the globe tax base is going to be essentially the financial accounts and the profits that are disclosed in those accounts. There will be adjustments made to that, certain adjustments. And as I mentioned earlier, one of those that's under consideration is, should there be an adjustment for timing differences? I think the answer to that question from Inclusive Framework delegates is yes, there should be an adjustment. The question is how you make that adjustment. So that's the broad architecture as set out in the Pillar 2 proposal. So I'm now going to hand over to Alexandra, I think it is, who's going to talk to you a little more detail about the issue of what we mean by timing differences and the sort of potential adjustments that you could make in the globe tax base. Thanks very much, and I'll hand over to you, Annie.
Thanks, Lee. Actually, I'm going to go first, talk about timing difference. Ali has the most important role of going through the potential solutions to the problems that we're discussing. So thanks. That's a good explanation of Pillar 2. I think now everyone kind of understands how it works. I mean, on the potential the way the minimum tax is going to be calculated for each multinational company. And so now this proposal is very interesting, and it could really address a number of profit shifting behavior that we've seen among multinational companies. But things are never easy, and the way the reform is designed now, there may be some unanticipated outcome that might not be favorable to to every country, and in particular to mineral-rich developing countries. So this one in particular, this is the issue of timing differences. So I'm going to explain a bit what timing differences are and why they matter for the implementation of Pillar 2, also known as GLOBE, as Lee mentioned. So the basic difference is that you have a difference between accounting profits and taxable income. And that difference is because accounting profits for multinational companies follow global norms, global accounting rules. So for example, the most famous ones are the IFRS and the GAAP as part of the Financial Accounting Standards Board. GAAP is used mostly in the US and other jurisdictions. IFRS is more popular in Europe, but both have global reach and a lot of companies use them. A lot of work is done by accountants globally to design these rules and review them periodically. And so really, these are standards that are followed by multinational companies across the board. That's how they report their profits, income, asset, liabilities at a global level. For example, in financial reporting, if they are listed on stock exchanges, that's how they report to their investors. They're regulated to do so. And so that's one way of that they declare their profits, asset, liabilities, etc. And then in these companies also have operations in a number of countries, and each country where they operate, they have to declare their income to the authorities, typically as part of the annual declaration of income and to the tax authority. And for these declarations, they use the local rules in each country where they operate. And then that's how they declare their taxable income in these countries. But each country has its own rules. And so there's some kind of common, generally accepted principles, but they are not typically the same as global accounting standards. They are different set of rules because they have different purposes. At the level of each country, the objective of the government is to regulate the way companies declare their income so that they can tax them at the right level, sometimes providing certain number of incentives to companies in when and how they declare their income. So that's how you have a basic difference between the profit that companies declare through financial reporting using global standards and the profits they declare in each country where they operate. Doesn't mean there is anything wrong with this. This is just the way things are. And it's only a problem here because the Pillar 2 requires that companies calculate their effective tax rate per country using their global accounting rules, which is different than what they typically do in each country. So that can create some differences. If I can give a bit more flavor of the different standards and what they look like, I just took an extract here of the annual report of a gold mining company active in Senegal in particular and Burkina Faso, Teranga Gold. In 2019, if you look at the annual report, you can see that they report their profits per subsidiary. And they do so following global accounting standards in this case, and see how they declare their revenue, profits, operating expenses, and net profits. Now, this is for reporting purposes. These are not the profits that are the basis of the taxes they pay in each country where these subsidiaries are located. This is just for reporting to investors. But in each of these countries, this company pays taxes according to how taxable income is calculated. And so we don't see their tax declarations because these are confidential documents. But through public reporting, we see how much the company is paying in taxes in each of these projects. So for example, here, the company is paying taxes in Senegal and Burkina Faso, and these are profit taxes. So as you see, one indication that there can be a difference that for the Burkina Faso subsidiary, Wanyong Gold project, you have a payment of tax about $50 million. But if you looked at the accounting profit of the company declared on Wanyong, it was negative. So that's an indication that the taxable income in Burkina was probably positive, even though, according to its financial reporting, there was no accounting profit on that subsidiary. So that was just to show how these different norms are used. Now, I would like also to show an example that really illustrates how the differences that I mentioned can play out, and why we call them timing differences or temporary differences. It's because they are not, they don't last. They reverse over time. The thing is, accounting profit, like rules, global rules on how to calculate accounting profits might be different from local tax rules, but it's mostly an issue of timing. Over time, the differences typically reverse, and the profits declared by companies over the whole life of a company, of a project, would be the same. And that's in particular the case with when there are differences in depreciation rules between the global accounting rules and the ones in the local tax rule in the jurisdiction. That's the most common one, and that's one that's at the source of the differences we're talking about here. The thing is that according to global financial reporting, typically depreciation of capital assets, the large investments that companies make, they're depreciated over the useful life of the asset. So that can take 15, 20 years or more. But typically in each jurisdiction, there's the depreciation rules allow the company to depreciate its assets over a set period of time that's typically a bit shorter, especially if there are some kind of accelerated depreciation rules that are incentives for companies to make large investments in capital expenditure. So in this example that you can see here on the screen, we took an example of a company operating 15 years making an investment of $50 million in capital expenditure. So typically a big processing factory for minerals. And you can see that in this example, we showed two different ways to depreciate this investment. So you have an accounting depreciation on the third line, which is proportional to the production of the company in its mineral production. And the fourth line is tax depreciation. So this is a straight line 5-year depreciation. So in 5 years, the assets is depreciated for tax purposes. So in total, the depreciation will be the same. It's just the accounting depreciation is much longer than the tax depreciation. So what that means is that if you calculate the profits, the accounting profits using accounting depreciation, you're going to see profits made by the company quite early in the project. But if you calculate the taxable profits using the tax depreciation, then you see that for the first few years of the project, there is no taxable profit. But when profit starts in year 5 and going through year 15, it is much higher than the accounting profit. And if you add the total of the accounting profit and the taxable profit over the lifetime of the project, it's the same. Here it's 84 in this case. The difference is the timing of that profit. According to accounting rules, it starts earlier, but it's more evenly spread out. According to taxable to tax rules in this jurisdiction, there is no profit made in the beginning, but there is more profit made later. So that's why it's a timing difference and not a permanent difference. So what that means for the implementation of Pillar 2 of the GLOBE rule is that if, according to the current blueprints, if it's applied to this company, this basic example, from the first year of production, you will see that the GLOBE effective tax rate will be 0% from year 0 to year 4 until year 5, because the company is not paying any taxes for these first few years. And that means that if there's a minimum effective tax rate, so we took 12.5%, which was the base assumption in including framework documents until recently, that would mean that there will be a top-up tax due. So the tax owed by this multinational company to its parent jurisdiction because it's not paying taxes above the minimum for these first few years of the project, and it will be paying. So here you have some numbers, and that's how it will end up to almost $2 million here of payments to the parent jurisdiction of the company instead of and not to the country where the mine is located. So that's what we mean by the impact of a temporary difference here on the implementation of the globe rule. You end up having, because you have just a difference in the timing of, for example, depreciation of capital assets, you end up seeing that multinational companies would be paying their parent jurisdiction instead of paying taxes on top of the taxes they're going to pay in the host country. It's just a matter of they would be paying these taxes later in the host country. And that's not taken into account currently in the blueprint of Pillar 2.
Thomas, if I can just interrupt you, we had a question posed to panelists from Abubakar that said, I don't understand the total of accounting depreciation in that example. Can you explain? The total seems less than 50. And then he followed up again saying the total of production value is 44, not 134.
Yes, sorry, I didn't explain the table properly, it's my fault. Here we are talking about an investment of a project that would be going over 15 years. So year 0, it's before the production starts, and it's the year of the investment. That's why you have investment here of 50 million. And then you have 15 years of production. So because we have a small screen, actually, there's a little cheat here. So instead of putting all the 15 years on the screen, I put the first 5 years, and then you have year 6 to 15. It's actually because it's a simple example, each year has the same profile. So that's why I grouped there from year 6 to year 15. You're gonna see the same amounts in that column here. So that's why instead of it's 134 the total of production value, because you have 0 plus 2 plus 4 plus 8 plus 10 plus 10, and then plus 10 not 1 time but 10 times or 9 times, yeah, 10 times. So that's why you end up with 134. If you look at the report, I think in our report we put all 15 years, so it might be more disaggregated. We're also happy to share the spreadsheet if you wanna see the formulas and how we came up with the computations. But thanks for the question. It's my fault. I didn't explain the table properly. So that was I hope this example was illustrative. So the main message is that so there are temporary difference between the taxes calculated on accounting profits and taxes calculated on taxable income, but these are temporary and they reverse over time. We think that they should be excluded from the calculation of the effective tax rate. Otherwise, it seems that there is undertaxation in the host country, even though there's not undertaxation. There is taxation, it's just postponed to later in the life of the project, which is typically better for capital intensive projects, and it's part of the regular incentives that are granted to companies, and that the only cost to the government is a timing one, not the total amount of. It doesn't change the total amount of tax that is collected. If the outcome will be the one that we just described, then it will be contrary to the core principle of the OECD BEPS action that taxes should be paid where the value is created, because then you will have taxes paid to the parent jurisdiction of the company where the value is not created in that case. There's also the outcome will be unfair, because you would see a shift of taxing rights out of the resource producing country to the country where the parent company is located. And that's not the objective of the reform, and that would be an unfair outcome. And finally, because it adds to the total cost of a project, the companies have to pay more tax than they were before, and they have to pay to the parent company. And in the early years of development of a project, that ends up creating an additional cost on investment, but especially on investment in the mining sector in developing countries, because developed economies, those that have large mining sectors, are not likely to be the subject of this, are not going to suffer from this rule to the same extent as developing countries, because they have more mining projects, and these projects can be, the income of this project can be blended together. You're not going to see the same outcome as in developing countries, where a lot of companies have maybe 1 or 2 projects, and they are more likely to see, you're more likely to see no taxable income in the first few years of a project. So I'm going to stop here, and I think we described the problem. Let us know if you have any question. We know it's a complex issue. It took us a lot of time to really grapple it, understand how it was going to work out. So don't feel ashamed to ask any question. It's a very complicated topic. And now I let Ali discuss some of the solutions that are proposed.
Thanks very much, Thomas. And also, I understand from the chat that the Spanish translation is not working. Apologies for that. I think our colleagues are trying to resolve the issue. So hopefully it's been fixed already, but otherwise bear with us as we resolve it. For those colleagues who've just joined us or joined us recently, you're able to select the interpretation language that you prefer. Down the bottom of the screen, there should be a small round globe of the world in the bottom right hand corner. If you click on that, it should give the option to choose English, French or Spanish. And so choose the language that best suits you, and then hopefully you should hear the interpretation. Great. So thanks again to everyone for joining us. As Thomas said, we appreciate that this is quite a complicated topic, and it took us a long time to get our heads around as well. So we're very grateful for you joining us and going through all of this together with us. So as Thomas mentioned, I'm going to talk about the solutions. So Lee's outlined what Pillar 2 is about, what are the policy objectives, how does it work in practice. Thomas has spoken about the specific issue of timing differences and the problems that that presents for the mining sector, and more specifically for revenue collection by resource-rich countries. And I'm going to talk about what are some of the potential solutions. I think Lee mentioned at the start that the inclusive framework, members of the inclusive framework and the OECD Secretariat recognize that something needs to be done to resolve the problem of timing differences. So then it becomes a question of how. So I'm going to talk about the potential policy solutions to address timing differences and briefly explain the advantages and disadvantages of each of these proposals. So Thomas, if you can turn to the next slide, please. Thanks. So the OECD's default proposal to reconcile timing differences is a combination of local tax carry forwards and income inclusion rule tax credits. So basically what this means is if a multinational has paid top-up tax on income in a jurisdiction, excess tax paid in that jurisdiction creates a tax credit that can be used to reduce the parent company's tax liability in the residence country or elsewhere. So you pay top-up tax, it's in excess of what you should pay, then you get a credit and you offset that credit against your taxable income in the residence country or anywhere else that you choose. On the other hand, with the local tax carry forwards, in that case, excess taxes paid in a jurisdiction that do not create a tax credit create instead a local tax carry forward that can be used to increase the effective tax rate in that jurisdiction in which the excess tax arises. Okay, so in one instance, you get a tax credit, so it reduces your taxable income. In another instance, you get a tax carry forward, and so it increases your effective tax rate, which means that you then don't have to pay any additional top-up tax. So this is the default proposal in the blueprint, but as the OECD and members of the inclusive framework have recognized, it's not an adequate solution for particularly capital intensive industries such as mining, and would lead to excessive taxation. The OECD acknowledges this and has proposed two alternatives. If we can go to the next slide. So the first proposal, and in our view the most promising one, is deferred tax accounting. So deferred tax accounting, or a deferred tax liability, is essentially a tax that is assessed for accounting purposes or is due for the current period but has not yet been paid. So the deferral comes from the difference in timing between when the tax is accrued and when the tax is paid. So in the example on the screen, which continues the example that Thomas shared, so using that same example, we apply the deferred tax accounting proposal. So in this case, assuming a corporate income tax rate of 25%, the deferred tax liability would amount to 1.25 million in year 3. Deferred tax accounting would then add that deferred tax liability of 1.25 million to the numerator of the effective tax rate fraction. So that is the taxes paid. So the effective tax rate would be equal to the statutory rate of 25%. So what this does is neutralize the effect of the tax depreciation or the timing difference on the effective tax rate. So moving to the next slide, the benefits of this approach, so the benefits of using deferred tax accounting, are that it's widely used in financial reporting. It's governed by international financial reporting standards. It's audited or independently audited by accounting firms, which gives it a degree of transparency. And it's less burdensome than dealing with what would be a proliferation of tax credits under the default proposal of using income inclusion rule, tax credits and loss tax carry forwards. Now, the main risk with deferred tax accounting is the degree of judgment that's required. So you think, well, the idea of deferred tax accounting is you're estimating how much tax you are liable to pay in future. So there is a degree of judgment that taxpayers must exercise in order to come up with these figures. However, the areas where judgment or where the taxpayer has to exercise judgment is involved are relatively few and can be addressed. The main one is uncertain tax positions. So this is where companies are in a dispute with a tax authority. So this is they're unclear as to how much tax they're going to have to pay or what the tax treatment is that's going to be applied. So there's a dispute. They don't know how they're going to come out of that dispute, how much tax they're likely to pay. So they're going to have to make an estimate for the purpose of financial reporting. So this one is quite uncertain. And it could be that much less tax is paid in future than what they estimate, or that no tax is paid at all. So this is the area where judgment is required, or perhaps is most material, or where the result of using judgment is potentially most material. But we do think that it is possible to address this. So effectively, all you do here is you say that companies must exclude uncertain tax positions for the purpose of calculating the effective tax rate. So you go through and you look at all the different areas where judgment is required under deferred tax accounting. Those areas that are most material, you then effectively cauterize or you exclude from the computation of the effective tax rate. So uncertain tax positions is the most important one, the most material one. There are others that we elaborate on in our note. I won't talk about them now, but I'm happy to discuss them in the Q&A. But it is possible to deal with these specific areas where judgment's required to limit the risk of manipulation by taxpayers. In our view, deferred tax accounting is the simplest way to resolve timing differences. It's something that taxpayers are already doing. They're used to it. It's relatively easy from a compliance point of view. It's more transparent. That is provided there are rules to exclude uncertain tax positions and to protect against abuse of the system by companies or governments. Moving to the next slide. Thanks, Thomas. So the other proposal on the table is to use local tax rules on depreciation and cost recovery allowances to determine the denominator rather than the rules used for financial accounting purposes. So essentially this says, well, if you're a company operating in Zambia, then we're going to apply the local tax rules on depreciation in Zambia in order to calculate your the denominator in the effective tax rate calculation. So we're just going to apply the local tax rules here, not the local tax rules, you know, writ large or in general, but rather the local tax rules that relate to depreciation and cost recovery allowances. So the tax rules that are likely to create timing differences. So using the previous example again on the slide in front of you, you can see that under this approach, local tax depreciation rules would be used in place of the accounting depreciation rules to determine the cost of the equipment for the purpose of calculating the effective tax rate. So in this case, there would be no profit reported under GLOBE until year 5, just as there is no profit reported according to local tax rules. So you achieve the same effect as deferred tax accounting. It's just a different approach, whereas under deferred tax accounting, we're incorporating deferred tax liabilities into the calculation. In this case, we're applying the local tax treatment and achieving the same result of neutralizing the effect of depreciation on the effective tax rate. So the main benefit of using local tax rules rather than deferred tax accounting is that they're generally considered to be less vulnerable than deferred tax accounting. So whereas deferred tax accounting requires a degree of judgment by the taxpayer, in this case, you're just applying the law that is in place in that particular country. So it should be transparent, it should be very clear. So there's no manipulation or judgment required by taxpayers. They're transparent, easily verifiable. The main challenge, of course, is the complexity. So if you imagine you're going to have to look at the relevant local tax rules in a huge number of jurisdictions, identify specific capital expenditures to which those local tax rules should be applied for the purpose of calculating the effective tax rate. And then you're going to have to verify the local tax rules to ensure that they actually conform with Pillar 2, because you could envisage a scenario where countries start to compete on these local tax rules around depreciation and cost recovery in order to attract investment, because they can't do it in relation to their headline corporate income tax rate. So they might start to compete or design those rules in a way that doesn't really comply with or conform to the spirit of Pillar 2 in terms of eliminating tax competition or minimizing tax competition. So that's the challenge, is that you're going to have to verify all those different rules. But nonetheless, local tax rules could resolve timing differences similar to deferred tax accounting in a way that involves less judgment and estimation, but with more complexity and potentially a higher compliance burden as well. So thanks, Thomas. Sorry, I should have moved to the last slide. So essentially we have these 3 options. We have the default mechanism, which we all agree is not really appropriate for something like mining, which involves significant investment, long production periods. And then we have deferred tax accounting and local tax rules. And each of those options have advantages and disadvantages. We think that deferred tax accounting is probably the simplest way to go, provided that you can limit or cauterize those areas where taxpayers are required to exercise judgment, so as to avoid any abuse in the system. So I'll stop there. Thanks for listening. I hope that's been useful.